RBI and credit control instruments. The Reserve Bank uses various quantitative and qualitative tools for managing liquidity in the market. Let's discuss the quantitative credit control instruments. First one, bank rate. It is the rate of interest charged by RBI from the banks on the loans and advances given to them. As per Section 49 of RBI Act 1934, bank rate is the standard rate at which the bank is prepared to buy or rediscount bills of exchange or other eligible paper. Second one, open market operations. It means sale and purchase of government securities in the open market by banks. This technique is used to expand credit by selling government securities to RBI and to control the credit by buying G securities from RBI. In the past, open market operations had been used as an important means of credit control. But nowadays, with the introduction of Liquidity Adjustment Facility, also known as LAF, open market purchases and sales are taken over by LAF instrument. Third is reserve requirements. One of the most important functions of central bank is formulation and execution of monetary policy. The Reserve Bank traditionally relied on direct instruments of monetary control, such as cash reserve ratio and statutory liquidity ratio. CRR and SLR are the reserve requirements used by RBI to control credit. The primary reserve requirement is cash reserve ratio. Cash reserve ratio indicates the quantum of cash that banks are required to keep with the Reserve Bank as a proportion of their net demand and time liabilities. Section 42, subsection 1 of RBI Act requires every bank to maintain an average daily balance with RBI, the amount which shall not be less than 3% of total demand and time liabilities. The CRR varied from 3% to 15%. CRR is usually used to tackle inflation arising out of too much liquidity in the system. The secondary and supplementary reserve requirement is statutory liquidity ratio. SLR prescribes the amount of money that banks must invest in securities issued by the government. It is the mandatory investment in government securities. According to Indian Banking Act 1949, a bank is legally bound to keep 20% of its deposits in the form of liquid assets, such as gold, approved securities and G securities. That was amended in 1962 and raised SLR to be minimum 25%. This ratio is used as a technique of liquidity management that is raised to control inflation and reduced to increase money supply. SLR reached its peak of 38.5% in April 1992, that is reduced to 25% in phased manner. The next main tools are qualitative credit control instruments. IT is also called selective credit control. These are selective controls with specific areas meant for certain specific objectives. They do not directly affect the quantity of credit, rather qualitatively selectively control the credit. The purpose of selective credit controllers to change the composition of credit by reducing the supply of credit in certain areas and encouraging in desired directions. It includes a. Fixation of margin requirements. RBI directs banks to change their ceilings and margin requirements from time to time, depending upon the purpose, state, security and time dimensions of credit. For example, the margin requirement for wheat was fixed at 40% in 1957, it was raised to 80% in 1958 and reduced to 40% again in 1970. There are multiple differentiated margins, that is, margin requirements varied regarding various commodities from time to time. B. Fixation of minimum lending rate. RBI also fixes minimum lending rates in order to control the cost of credit rather than availability of credit. C. Fixation of maximum limit of loans. RBI sometimes imposes limit of loans by commercial banks in order to check speculation. No scheduled commercial bank is allowed to grant loans exceeding 1 crore to any single borrower without the prior permission of RBI. D. Credit rationing. Under the selective credit control, RBI fixes credit quota for member banks, and their limits for payment of bills. If member banks seeks more loans than their fixed quota, they will be charged high interest rates than normal rates. A. Moral suasion. This is the most actively and consistently used technique of monetary control. Since the nationalization of banks, RBI can morally influence the member banks by writing letters and holding discussions about trends in economy in general, and in money and credit particularly. It advises them to expand credit in priority sectors only. Here, the basic purpose is to seek cooperation from commercial banks to effectively control the monetary system and the economy. F. Direct action. RBI can also resort to direct action against any banks, in case of defiance of its orders. RBI can take any measure of action like stop giving advances, closure of banks, etc.